In 1852, Henry Wells and William Fargo founded an innovative startup company that helped people and businesses manage and build wealth. So how did Wells Fargo, a company that survived the banking panic of 1857, a half dozen or so recessions, and the Great Depression, go on to defraud millions of its users? Let's get into it. All right, well, welcome back for another episode of Theory of Why. This is episode number 6, and so far the response to the show has been pretty interesting. So anytime that you have a lot of short form content on YouTube, it's bound to get a lot of interesting comments. So as I predicted, the minimum wage episode was highly controversial, and to this day, I'm still getting comments in the comment section about it, which is great. I love the engagement. So I'm going to do an episode on some responses to those comments down the road here. But for today, I want to talk about Wells Fargo, which is a bank that's synonymous with the American economy, and it has faced scandal after scandal in the last 10 years. And it's a really interesting case study in how small businesses, as they grow, can lose their identity, can lose their vision, and ultimately change the path of why they started. So just to give everyone a little bit of a rundown here. So the major Wells Fargo scandal took place in 2016. And to give you a Cliff Notes version of it, basically the bank had very high sales requirements. And during that time period, employees were very pressured to hit these sales marks. Now, when you think of a bank, you might not necessarily associate a bank with sales quotas and things like that, like you might a car dealership, but banks function in a similar fashion in that people are responsible for hitting quotas, a certain number of checking accounts, a certain number of savings accounts, credit cards, business loans. All of those are quotas that the bank has in order to meet their projections for that year. So according to a lot of the individuals that testified on this particular case, Wells Fargo had very aggressive sales figures. They created a very aggressive sales culture. And from that stemmed hundreds, if not thousands, of their employees opening accounts for their users. So essentially, if I was a Wells Fargo employee, I would have a list of existing clients, and to meet my sales quota, I would go ahead and open another savings account, a credit card, another checking account for customers that are already in the system unbeknownst to them. So people would get debit cards in the mail and have not requested them. And then over time, this started to build, more reports started coming in, and then the bottom fell out of this whole thing. And as this was going on, it started as early as 2011, although there's been reports that indicated it's been going on for some time before that. And then it culminated in 2016. And amid all of this scandal, their CEO, John Stump, decided to resign as there was a litany of other scandals that were coming down the pipeline. So one thing that was really interesting to me as I was looking through this was one question I should say is what creates a culture that causes employees to act unethically, right? And a lot of times the stress and pressure and, whether it's banking managers or regional managers pushing pressure on their, associates to open these accounts and hit these marks or else, well, if you have to choose between losing your job or opening accounts, that can create a culture where people do things wrong. Now, that doesn't mean that the employees are off the hook for their actions. You have to be responsible for your own individual choices. But likewise, the company needs to be responsible for the culture that it sets up and what that culture leads to. And in this case, it led to millions of unauthorized checking and credit card accounts being opened for their customers without consent. So that sounds bad, right? It's a terrible thing, but that's not the only scandal that Wells Fargo has faced in the last 10 years. So in 2017, there was an auto insurance scandal that led to over 25,000 vehicles being wrongfully repossessed. They also charged inappropriate mortgage lock fees, and this took place in 2018. So basically, they were charging people for a fee to lock in their mortgage, and that was deemed inappropriate from the SEC. There was issues with their foreign transaction policies and the fees and rates they were charging for overseas business. They rigged the bond market in 2018 to have advantageous outcomes for certain preferred players in their customer pool. And all of this culminated in 2020 when the bank agreed to a $3.7 billion fine for their sales practices and misconduct that related in some part to all of these scandals. So the question is, are all of those accounts, is all of that manipulation that was taking place in the back end, was it worth a $3.7 billion fine? And obviously, no, it's not. And this is where short-term thinking and short-term solutions can really sink a business long-term. Now, as I'm recording this, Wells Fargo is still in operation. They're reporting well under their projections. Their stock price is down, so they're not, at this time, according to most economists, at risk for dissolving. But they are in a very poor spot financially compared to where they thought they were going to be. Now, what happens a lot in business is you get hit in this pinch where you're like, I got to make things happen. I have to do things really quickly. And in that speed comes a lot of mistakes. Now, when you have a bigger business, there's a couple of different problems that you have. One, you can't course correct as quickly because you have tens of thousands of employees that need to be on board for that plan. Secondly, you can't identify problems as quickly and solve them because of that same reason. So if you discover you have employees engaging in this illegal activity and it's been brought about by the culture that you've implemented, it takes a really long time to course correct and change the culture and stop this from happening. This is an organization with tens of thousands of employees, and it's difficult to change that direction as time goes on. But what you can see here is this is systemic. This is not necessarily in just one department. It's not just in the branches. When we look at the auto insurance scandal, on the mortgage side with locking in rates, the foreign transaction policy. So this is a company that started as a cornerstone of the American economy and then went on to be synonymous with banking fraud. And to this day, the trust in this particular corporation is at an all-time low because of these continued scandals. They continue to try and restructure their corporate board. They continue to try and dump money into, let's call it the charitable economy. And these things are not helping with their image because for every great thing that they do from an internal perspective, it is offset by another scandal. So in all of this, the question remains, well, how does this apply to small businesses? Because obviously every business that started, whether it was with Wells and Fargo in 1852, it grew to a massive corporation, one of the top banks in the world. And every single step that you take up as you go from a small business to a large business, that culture, your why, the reason that you exist has to be deeply ingrained in every single step. And that's a difficult thing to do. It's challenging. As you get new partners, new shareholders, new investors, everyone has a different agenda and a different direction, even if it's ever so slightly that they're trying to steer that ship. So it can be difficult for one person to continue that mission. Moreover, as you have a generational business, as that changes hands as time goes on, those things can be different because you have the children that might inherit that business having a different vision than the company's founder. So it's difficult to maintain a business for 100 years and maintain the same standards that the company was started on. Anytime I see a business that's been around for over 100 years and they've maintained the reputation that they've started on, that's an incredible feat. And it's always interesting to read more about how that happened. How were they able to scale that? And that's an interesting case study and model for people to follow that want to create a legacy business that's generational. And in Wells Fargo, there's a lot of different things you could point to as far as how this happened. And I'm certainly not saying this is the sole reason why this went down. But what I look at is in 2008, Wells Fargo was one of the biggest beneficiaries of the bank buyout. They were one of the banks that did the best through the recession in 2008. As a matter of fact, they were given $25 million from the TARP program and ended up paying it back the next year. And they were one of the only banks that posted a profit during 2008. So they did well, but that mentality of, while the economy is suffering, we're going to take a bailout, we're still going to have executive compensation that's rather high. That was the first year that CEO John Stump was running Wells Fargo, and his 8-year term that ended with all of these scandals, I think was born out of this idea of, we just went through a recession, things are going really rough, we need to focus on profits, we need to drive sales, we need to drive volume in business. And I think out of that came this culture of, we're going to do literally whatever it takes in order to be successful, which is not a great business model to have, as they've demonstrated here. So it's interesting to me to see how such a small event can have such a large ripple effect in a business. Even in this case, where Wells Fargo was one of the banks that was performing the best during the 2008 collapse. They were performing the best, but still out of that came all of these scandals and wrongdoings that they did to their users. And even now, as we sit here in 2023, we're almost 8 years on the other side of the 2016 scandal for all of the accounts. That damage control is still a central part of their marketing, as they're trying to draw back to their roots from the 1850s and dial their marketing back to using nostalgia to get people to resonate with that bank. And I think it looks, in my opinion, bad. It looks bad to not lead with this as a problem and be extremely transparent on how it's being fixed, because every time they talk about something that they're doing to fix it, another scandal emerges, another settlement takes place. The $3.7 billion fine, that was just, I believe, paid in 2022. So it's all relatively recent. And there's a lot of work to do for this particular bank in order to earn trust back for people. And time will tell if they're going to go the way of Silicon Valley, if they're going to have resurgence and continue performing well and start to performing well by their customers. So we'll see. So for small businesses, this is a really good lesson in how you grow. What are the things that you're doing in order to take meaningful steps that have a true direction? Are you actually thinking about what your vision looks like at scale? This is something I think about all the time here at Wayne Media. We have 10 employees. As we go to 20 employees, what steps am I going to take to make sure our culture is able to stay how it is with massive growth? And that's a challenge. Anyone that tells you it's easy or it's super simple, or you got to just read this one book or whatever, they're lying to you. It takes work. It takes effort. It takes pouring into your people. It takes developing leaders. It's certainly not a one-man mission to be able to scale effectively. So I like looking at larger companies and seeing the problems that they've had and reverse engineering those into small businesses to see what steps we can avoid to not go that way. And granted, there's very few businesses will ever reach the revenue, the volume, the size, the influence that Wells Fargo has. Vast majority, over 99% of businesses will never reach that. But it's still, nonetheless, there's a lot of lessons and principles that we can apply to the small business sector from this example to ensure that things don't go awry. And a big part of this is culture. So what type of culture does your business have? And is that culture forcing people to make mistakes? Now, I want to make sure I'm really clear here, because I don't want to give the opinion that I think that the people that opened the accounts that were under that pressure, that they're off scot-free and they don't have any play in this. They certainly do. When you're pressured to do something, or when you have a culture that's pushing down on you, you have to have integrity enough to say, I'm not going to do this. I'm not going to do something dishonest just to benefit myself or just to get off the hook for something. You have to have some type of moral standard that you can fall back on. So I don't believe that anyone that opened accounts wrongly and took advantage of customers that trusted them, they're not off the hook either. I think they're just as much to blame as the bank that created that culture. And that's something as a leader I look at all the time is, what does work-life balance look like? What does our stress look like? What does our bandwidth look like? Because all of those things drive people to either make decisions very quickly or gloss over details or not have enough time to look at something properly, and then you miss something. So if everyone is constantly rushing around and they can't take a moment to stop and look around, mistakes are going to be made. And then over time, as that pressure increases, it's going to drive people to do things in this same fashion. So it's a really...
I want to stop you right there, Rob.
Go ahead, John.
So what's the benefit that they realized out of it, other than just showing on their bottom line that they had, one time they had 300,000 accounts and now they have 350,000 accounts, right? Just a difference in accounts. Is that going to make people want to insert more money into their bank, do whatever? What was the ultimate benefit they were trying to gain out of that?
I think from a market position perspective, if banks say we have this many accounts, we have this many checking, savings, credit card accounts, that then gives them more credit and stature in that particular banking economy because they're showing growth. They're showing more accounts set up, and they're not necessarily looking at the value of those accounts, because what was happening was so if I was a bank associate and I opened you a new savings account, I would take $5 from your checking account and put it in that new savings account and hope you didn't notice. So that's not like they were adding a ton of revenue into this, but they were adding a ton of accounts, which to their shareholders showed that they had, they hit their marks for all of their accounts, which gave the shareholders confidence to potentially invest more in the company.
Okay, that's what I thought they were going to be gaining out of that, to appear with a higher rating than what they were.
Yeah, absolutely. And that's the thing I thought about too as I was going through this, was it's not like they had an infusion of cash through this, mechanism. It was all around just the number of accounts, not even necessarily the monetary value that was going into them.
Okay, thank you.
So one last thing I want to end on is, obviously KeyBank is a sponsor of this podcast, and they have done a lot for our organization and have been a tremendous partner for us. So if you haven't had a chance to take a look at some of the programs that they offer, I'd encourage you to do so at key.com. One thing that I was looking at as I was reviewing just general banking practices was this ongoing theme of, I'm going to call them really bad business coaches giving advice online about how to obtain free capital from banks. Now, we're gonna put air quotes around the word free, because no money from a bank is ever free. But they want you to believe that this is just easy ways to get money to fund your business idea. And this came across my desk because KeyBank was listed as one of the banks that have a program. And as being someone that has went through the loan program at KeyBank and has went through that business process, I can tell you unequivocally that this is not how it works. And what I mean by this is not how it works is what I'm about to talk about in this next segment. So, Johnny, if you don't mind, go ahead and play that short that I sent you.
If you have a business and you're looking for funding with minimal documentation required, I'm going to give you some no-doc business loans that you can use. Disclaimer, no-doc doesn't mean that there's no documentation at all required for these loans. What it means is that there's minimal documentation required to apply for these loans in relation to traditional lending institutions. And there are minimal requirements that your business must meet in order to qualify for these loans. The first type of no-doc business loan would be what they call an unsecured business loan. A good place to go for these type of loans is with a company called Cabbage. You could get up to $250,000 and all you need is a minimum 640 FICO score. The next type of no-doc business loan is what they call a business line of credit. A good place to go for these type of loans is with an online lender called OnDeck. With them, you can get up to $100,000 and all you need is a minimum 600 FICO score. The next type of no-doc business loan is what they call invoice financing. A good place to go for these type of loans is with an online lender called Bluevine.
So I just want to stop right there. So I think people can get the gist of what these consultants, and I'm using that term very loosely because I don't believe any of these people have ever structured and scaled a business once in their life. But that last thing he said about OnDeck. So I have the OnDeck website in front of me right here. And he said, all you need is a 600 FICO score to be able to obtain this business line of credit. And that's just simply not true. Right on the On Deck website, there's 4 main things that it requires you to have. It's obviously a business with an EIN, $100,000 in annual business revenue, a 625 personal FICO score, and a minimum time in business of 1 year. So what's happening with all of these individuals who are drilling false information into prospective business owners, and they're just doing this to get views and attention online, to pass themselves off as experts in this field, but they're not giving people all of the details. There's no bank that you can walk into just starting a business that will give you $50,000 as a line of credit or as a business loan without some type of substance behind it. A business plan, an actual business model of how this has worked before, some type of cash infusion from another investor to show that there's actual cash in the business. There needs to be something more than just, hey, I had an idea for a business, I opened an EIN, and now I'm going to get access to all of this capital from a bank. It doesn't work that way. You need to have supporting documents. And what's irritating about this whole thing is even this video is titled How to Obtain a Business Loan with No Docs. And then he opens it up by saying, well, no docs doesn't really mean no docs. Then don't say that. Don't say it doesn't mean no docs. How about here's a strategic way to get funding for your business, but it's going to take some work, because all of that takes work. And there's a gig economy online right now that makes it seem like tools like drop shipping and e-com and all of these fly-by-night types of business models are the way to do it. And people will show you how they've done it for a month or so and then call themselves experts and try to get people into their class or into their training. You know, they have a master class on how to obtain business funding that you need to pay for. And it's all of these fake methods in order to gain attention so that they can draw revenue back to their class or their widget or whatever it is that they're trying to sell. And it's annoying for me because when I see the amount of volume that this drives to banks and it's just going to get shut down, it just does nothing but tie up organizations because of all of this disinformation. And I have it on very high authority that this is a very true thing that happens. People in the banking industry are flooded with calls and requests from this. I even saw one individual online, and I'll put the link in the description so you can check it out. But he was saying that if you're so he gave a list of like 5 banks, and all of these banks don't obviously operate in all of the states. But he was saying that all you need to do is just open a foreign entity in that particular state. And which, again, that's not a foreign entity. That's just registering a business in another state, but that's for another matter. You need to register your business in another state, go on Regis, get a virtual office showing that you have an address in that state, and then go and apply for the bank loan. And to me, that's just fraud. That's manipulation. That's you trying to pass something off as something that doesn't exist in the way that you're representing it. And that's not a great way to start a business. That's no ethical foundation to build a successful company. So if that's your plan, if your plan is to open a business and then to do nothing but manipulate and cheat your way in order to get funding and try and take advantage of financial institutions, the market will take care of you. I'm not really worried about you. I'm more so worried about the people that are spreading this message and encouraging people to do stupid things like this. It's annoying. And I want to see this stopped online. And I know in time the market will take care of this because people are going to go through this cycle of trying to get this funding, opening businesses, realizing it's not going to work, failing, and then moving back to the workforce. So if you see people online that are doing this, which it's running rampant right now, just know that there is no institution that you as a brand new business owner with no experience, no revenue, no one is going to give you any funding at all without either tying you to some type of personal guarantee, so putting up your house, because even on deck, they pull your personal FICO score because they're going to tie that business loan to your personal credit. So when you default on that business loan, they can go after your personal assets. And that, to me, is not a business loan. A business loan is something that is secured solely and only to the business, not to someone's personal assets. So anytime you're going after funding like that, you need to think about that. So this doesn't just affect the business, this could affect your personal as well. So can they go after your house, your car, your personal banking assets? And all of the reasons that they pull this personal FICO score is because in the contract that they send you, which you're probably not going to read, they're going to tie it to your personal finances. And that's how they're going to collect their money once you default. So these are all things that these business coaches don't want to tell you because it doesn't sound as sexy as you can get $50,000 in funding with no docs. It's ridiculous. What do you think about that, Johnny?
Well, I think it's just like everything else. There's always someone out there trying to scam somebody else out of something, right? And it's just false to get you to click on it, to draw you to somewhere else, and then scam you from there.
Yeah. It's true in any industry. There's always going to be a small contingent of people that are trying to rip you off and take advantage of you.
Yeah, it's almost, I kind of have an old saying that says, I just wish people would work as hard at trying to help people as to try to hurt them.
Yeah.
Viruses, all that kind of stuff is just ridiculous.
Yeah, it's like if you put as much effort, and that's the thing too, like if you were trying to start a business and you put as much effort into trying to screw over these banks as you did into actually growing and starting your business, you'd probably have enough revenue to where you wouldn't need the funding from the bank.
Correct.
So it's just, it just blows my mind. And I was thinking about like when I first started Wayne Media, like I had to go and obtain a personal line of credit for the business that was tied to my personal finances. And all of this was a calculated decision. And it was something I never wanted to use unless it was absolutely necessary. And the idea of like, oh, this is just free money that you can use on whatever you want is absolutely ridiculous. Just because it's there doesn't mean you ought to use it for anything and everything.
Right. I mean, there's plenty of other loopholes that are out there in the world that are still legal, right, to be able to get through. And yeah, it's a shame.
Yeah. So on the leadership quote side of the podcast, I wanted to pull a quote from Zig Ziglar. This is one I've heard several times, and I thought it was really applicable to the conversation today, which is, you don't build a business, you build people, then people build the business. And this speaks to the culture and the investment and the pouring into that you need to make into the employees that you have. Because at the end of the day, those are going to be the people that continue to grow and scale the business, because it is not a solo effort. So Zig Ziglar, excellent business consultant, prolific author, no longer with us, but definitely someone to check out and read if you have not studied any of his material. And lastly, Proverbs 13:20, walk with the wise and become wise, for a companion of fools suffers harm. So if you're a business owner, the question I want to ask you is, who is in your circle? Who are the people that you are following around? Who are the people that you are tying yourself to? Is it people that make really bad decisions and they run their companies foolishly? Or is it people that continually try to seek wisdom and get better at their craft? Because just like, if you're a parent and you tell your kids, hey, if you hang around with losers, what are people going to think you are? It's the same thing. The people that you hang out and have in your social circle, in your circle of influence, represents the type of person, type of business owner that you are probably going to become. So that's going to wrap up episode number 6 of Theory of Why. Appreciate you all watching. If you're an audio listener, check out the YouTube channels. You can see the videos that we're talking about during the show. And if you're a YouTube user, just remember that this podcast is available on the go, Apple, Spotify, iHeartRadio, all places that do podcasts. So thanks for watching, everyone. We'll catch you next week. Take care.